Alright, welcome back. So now we're going to do a video on trend lines. So we can see and identify, trend lines like this, right? There's a clear trend line there. There is a clear trend line here. There is a bigger trend line here, right? Which also continues on. It's a nice trend line here. And there's definitely a very exaggerated trend line there in comparison to the others. But regardless, these are all trends. These are all trend lines, And a trend line, what it is a line that shows accumulation or structure to the upside if it's accumulating, and or distribution if it is moving to the downside. It also shows the structure of the candles and how they're moving, and it shows the structure of the candles of how they're moving onto the downside. It also shows a level of rejection on the trend line, okay, and a level of acceptance on the trend line. So these, depending on your trading plan, would be an area of 1, 2, 3, right? 3 confirmations, they say, and that's an acceptable trend line. But the beauty about trading is that whatever your trading rules are, it can be whatever you want. So maybe with a 4-hour, that's your trend, and that's perfectly alright as well. There's no wrong answers. The answer is really whatever you want it to be in terms of how you trade. So if your trend was to be just this here, and you had a breakout of the level here, now you've got a valid trend with a breakout and a buy signal here. So on that wick, you've got a level of support here, previous resistance, now support. Remember, this is a 4-hour time frame. Okay. So there's our trend, 1, 2, and we have a potential third here, which is liquidity wick. So we could probably get an entry on the retest, so the break and the retest, or if we wanted our trading rule to be 1, 2, 3, then our entry would be on the third wick of the touch of the trend line, and that's depending on how you want to trade. We also have a trend from here to here, right? Now the acceptance of this trend is that it has broken the trend here, right? So we have a break of trend, and then a new trend has formed with a level of rejection along this trend line. So our potential entries would be within these zones, in these wicks. All right, we have structure of the candles moving down, and therefore the validation of that distribution phase is valid, and that trend is valid. So it depends on how you look at the market. So distribution, accumulation, and we have a break of trend here, right, which confirms an accumulation phase here. So we could use 1, 2, 3. That's a nice bullish engulfing there. And then we have to tie into our resistance area, right? So as our potential take profit area. So now we're using trends to find momentum, to find periods of accumulation and periods of distribution. Okay. And then we're using the resistance, like I said in the previous video, for our potential take profit area, and the support or break and retest. Now support, resistance to support in an area of previous support. Right, we do have support here, demand, support. Okay, which also gives us that previous rejection, now retest like that, and we've got another trend here, pull back, right? So period of distribution, or take profits. So you break, boom, and you could be coming up to that level of resistance again. So you know whether you're buying here as the retest, or whether you're waiting for the conservative break of trend here and then buying here. There's plenty of opportunities in the market, and you know it's all depending on how you view the market and your trading rules. So there's a period of accumulation here, right? So, and a trend line will, you know, you want to look for that support. Now we're talking about trend line support. Okay, so we're finding a trend that's valid, that's now acting as dynamic support. So where price is moving with the trend, and we have the rejection here of the, even though it's in a channel, so now we're in a channel, and our potential take profits are here, our re-entry is here, another take profit here, re-entry in this zone, and take profit here, and then it breaks there and it retests our higher channel. So break, retest, and it also breaks here, our previous rejection zone. So this to me does say that, you know, we may be overextended, but it also does show that price can be pushed up. Now we haven't broken this zone here, so technically we're still bullish until we break the range of the high or the low, which we've broken high, meaning that there are buyers to push up price. So we do get a rejection here and here and here, right? And now we have another trend. So 1, 2, and 3. Maybe we're getting into this zone here, previous support there, now resistance, and I'm shorting back down, back to this area here. So as a conservative take profit. So that's why it's important to mark these zones, right? The zones of interest always. So that's our previous area of support, bang. So if we were to follow the trend within this channel, right? 1, 2, 3. So we have a break of the support here, break, see bearish engulfing. So break of this level. Depending on you might witness that there's a whole bunch of rejection wicks there to the upside. So you're looking for potential short out of the break and close of the range, and the range is quite small on these candles. The range is here, and the rejection's here. So you know you're probably looking for a short within here, take profit there, pull back, another resistance here, and entry potentially in here, or you know you're looking for that break, which you don't really get, but you do get a lower high on these wicks here in comparison to here. So that and look, you get a retest on the trend, so you could have another short here. So you could scale in or take 100% profit, new trade, you know, depending on how you want to trade. There's plenty of opportunities in the market. And then you're looking at this major zone here, right? Major zone there, bullish engulfing, bullish engulfing. So this zone got broken quite easily. So usually, you know, when you have a bullish engulfing out of the range, then there's a potential demand zone there, and that's how demand zones are created, which I'll go into another video. And I think that just about covers the trend. Right, but now I'm going to talk about, you know, the liquidity concepts behind trend lines. So this is, you know, it's a quite advanced topic, but we also understand now what a trend is. So it's a period of accumulation, okay, when price is above and respecting it. So period of accumulation. So we have pretty much, you know, a bull pennant here, right, which is you know, the chart patterns are just accumulation of distribution patterns. That's all they are. So it's a period of accumulation, and this is what is happening within this space to break out. But now what we do have is we have a scaled in entry here, scaled in entry here, scaled in entry here, scaled in entry here, scaled in entry here. So what do we have potentially running along the bottom? We have liquidity, aka stop losses, right? So if we have a long position, then we have a sell stop, because that's what a stop loss is. It's a sell stop. Pretty sure I have it the right way. There's a buy sell stop. Yeah, buy sell stop is when you short, and then there's a sell stop when you buy. So short sell stop, because obviously you're buying at a negative, and you or you're losing at a negative here and you're losing at a negative there, but you have to buy when you short. You have to buy your stop. You know what I mean? That's why it's called a buy stop loss. And when you long, you have to sell, which is so you have to or short, which is called a short stop loss or sell stop loss. Short sell stop, buy sell stop. So now we have liquidity zones, right? And there is always liquidity zones. There is always liquidity zones, right? So you want to be on the right side of the market. So we had a period of accumulation here. It's come back and returned to this big support level, popped out of the range, come up, broken all the highs here, right? And the highs here would have had liquidity, right? Stop losses, okay, and they would have got taken out on the break here, bang. Probably the market may have tried to push below here, which they did, but they couldn't because there was too many buyers coming into the market, and that caused the imbalance and push the price back. So here we go here. So now we have that. So now we have all this liquidity here, right? So that's why in these late stages you want to be getting sort of taking profit if it's already moved quite a bit. You want to be looking to take profits pretty early. So on the breakout, and then potentially on the rejection or the lower high here, then you want to be out, because if we got in here, our stop loss is now at entry and we haven't taken profit. Well, guess what? We just lost the trade. All that work, all that effort for nothing. And if our entry was here, we've been taken out here, and if our entry was here, we've been taken out there. Okay, so that's where we get the liquidity concepts for trendline liquidity, and the market and the liquidity providers and the market makers, they can see where your stop losses are because you're registering your stop loss on their exchange, so they know where your position is. They know how big your position is. They know how much money's there, and anybody who tells you that the liquidity providers don't try to take your money, that's bullshit, because they do. They are in the market just as much as you are. So they understand where everything sort of is, and that's why you want to be on the right side of the market. So we have a clear move here, and you know what? People and institutions do hold positions for quite a long time. This is called position trading. That's why there's always liquidity at these potential zones, and we have a big rejection here. So a majority of the market has gotten out somewhere around here. They're like, nah, it's done. That's it. So 2,000 on gold, and I actually remember this. I had this drawn up, and then I forgot about it, and I was focusing on something else, and it went to 2,000, and I missed a whole lot. It was crazy. But now we have trendline liquidity, and here, right? So there's trendline liquidity there. There's liquidity here. Liquidity here, right? And this high tries to take out that liquidity, which we went across before in our resistance video. So supply is here. So we always want to know where liquidity is, and this is where liquidity majority is. But now we have some trendline liquidity here. Now these are easy pickings because it comes back up, bang, takes it out and takes it out. So now we have the liquidity in these zones, right? It's that the majority of the market's still short. Everyone thinks, oh, yep, it's going to just dump, but it comes back up, pops, takes all of the shorts out here, and then potentially takes some of the positions out from here if they've been trailing their stop in profit. And now we've hit this zone again, and the big guys in the market would have hit this hard. They would have hit it hard and shorted the absolute crap out of it, because there is another 6% move, and it's even bigger than this move in the space of a week. So there you have it. Now you've got a trend forming here, and you've got a trend forming here. Okay, so obviously the first trend shows us that yes, there is see the slope of the trend. So when the slope of the trend is like this, then yeah, it's coming down. But this low here, breaking all the lows in liquidity here, is a big saying in the market that yep, we've pushed down. Now we're gonna take out these lows, right? So we've got a lower low, and I'll get into structure in another video. But here's the trend. Here's the third rejection. So that's where pretty much the entry is, and then you got an aggressive trend line like that. So depending on the slope will depend on the aggressiveness of the market. So we have a nice slope here, slow burn there, right? Ranging, which is the ranging is just formation of distribution. Okay, we've got a big level here, all right, and we're pretty much there, leveling there. So sort of teetering along that level. Bang, this is a big confluence point right there. So now you've got previous support, previous resistance under one trend, and then pretty much exceeding with another trend, or the potential beginnings of another trend, and boom, boom, until we get to that double bottom zone at 1680. So there's huge moves here. If you were a position trader, that's 61 days of time, which position trader is a position trade for months, depending on how much commission is being charged for the hold of the short. In this case, will depend on how long they hold it for. So that's why the position they'll do low leverage, and they'll keep it for maybe a month, and then they'll close out, and then they'll look for another position, then hold it for another month and another month, etc. So, but yeah, that's about, and then again, we have the liquidity in these zones, you know what I mean? So zones and zones, where people are, all right, yep, my stop loss is there, stop loss is there. There will always be stop losses and liquidities along the trend line, or along the potential rejection zones, which I'll get into another video. And then the market now has targets. That's why we use structure targets, because we target structure because there's liquidity there, right? So if we want to buy, when we want to get maximum potential returns, then we need to have maximum potential liquidity for us to get our full position size filled at that current price. Okay, and then we have another, once we have the period of accumulation, which is here, double bottom is an accumulation phase, and then we have another trend. Period of accumulation, break out of the accumulation area, retest there, an extremely nice slope on that trend, and continuing on until we break, boom, break below, and we have a new structure forming to the downside. All right, so I think that's enough about trends, and I'll get into structure next.